Hello and welcome to Smart Money. I'm Alishia Seckam, and today we're taking stock of the local market scene within a global context and how that's impacting some of the decisions being made around asset allocation right now. Joining me to do just that, Bianca Botes, Director at Citadel Global, and George Herman, Director and Chief Investment Officer at Citadel as well. Welcome to you both, and thanks so much for joining us. And George, I'm going to start off with you because, like I said, we're taking stock. Locally, we've seen quite a few shifts triggered in South Africa impacting sentiment, the top two being a government of national unity that's in place, Eskom seemingly getting a handle on load shedding as well. And while that expected to filter through to South Africa's economic prospects, this an economy that's still operating within an increasingly fractured global economy. And so the risks are rife. So, with various push-pull factors in play, what's South Africa's economic growth forecast looking like in your books?
Alishia, you touched on many of the important points straight off the bat. Yes, the world is in turmoil right now, but South Africa is in a good space of that. We are beneficiaries of stronger commodity prices. The lower oil price suited us. Most recently, oil price a little bit higher. But overall, the prospects for South Africa has suddenly lit up. Why is that? It's because after a decade of being caught in this low growth environment, suddenly having a government of national unity, suddenly hope springs eternal, sentiment improves, and people realizes that if government delivers to its clients, the population of South Africa, that things can happen. And suddenly the growth prospects for South Africa has improved. It's being marked up. The government is aiming for something north of 3%. I think it's a little bit ambitious, but we get growth to north of 2% during next year, undoubtedly.
Bianca, look, in part, the rand's strength we've seen of late being attributed to that. But if we talk currency markets, global risk factors leaving any risk-sensitive currencies like the rand pretty vulnerable, right? So what trends or developments are you keeping an eye on as far as the dollar rand are concerned?
I think it really ties into what George just mentioned. When we look at the currency, however, I would be cautious to get too ambitious too quickly. As you rightfully mentioned, emerging market currencies tend to be open to risk, and any switch in risk sentiment can see a swift reversal in the value of the currency. We recently actually saw such a switch. 2 weeks ago, on the back of the Chinese stimulus, the rand went and touched just above the 17 rand mark. And then as risk filtered into the market, with the market saying, well, maybe the Fed is not going to be as aggressive in cutting rates, we saw the rand actually lose momentum to trade at the current levels closer to 17.40.
Yeah, that said, what are your projections for both these currencies moving forward?
I think the dollar is due to actually shed some of its value. It remains overvalued at these levels. And as we see interest rate cuts come through from the US, the dollar is expected to lose some of that value. That in turn is really beneficial for the rand, as the rand will gain momentum against the dollar. Currently, we do consider the rand to be in overvalued terrain, but that doesn't necessarily mean that we weaken from these levels. As George mentioned, there is a very good case for emerging markets and South Africa to actually benefit from this ongoing positive sentiment that we are seeing. And that really opens the door for the rand to continue into these overvalued levels and even see a break below 17.
Okay, so George, that's the big picture from a broad economic and currency perspective, right? In that context, what are the major emerging global investment trends that you're noting? And more directly, to what extent is your stance on them impacting your asset allocation strategy?
The first part of the question, Alishia, is the trends. The first important trend is everything around artificial intelligence. AI has forced the global technology companies to really dominate the scene, so much so that much of the returns have been concentrated in only the top 5-6 shares, if I talk about the United States, and the other 495 in the S&P 500 have hardly done anything. And that has been the biggest theme for the last year. Can that continue? It seems unlikely because the earnings potential of those tech companies do get eroded as time goes by. And now, as interest rates start being reduced, we should see a broadening of performance into the rest of the economy. So that tech-focused mega cap outperformance and concentration of the markets was the first and most important theme. And that was a very important one for us to manage, because it does have some memory of the tech bubble of 2000. And so those risks have to be managed. I think the other trend that I've noticed over the last 5 years is the hunt for private assets, because not all assets want to be listed or need to be listed for that matter, but there are wonderful investment opportunities in the unlisted environment. So both private equity and specifically private credit has grown immensely. So there's been a lot of demand from investors for those products because it's in the limelight. The problem with those things is lack of liquidity, lack of market pricing, etc. So welcome to go into those. In fact, we have gone into the private credit space somewhat, but you have to manage your position sizing very, very closely. In terms of overall asset allocation right now, the world that we've described of slowly slowing down back to capacity as the US cools down a little bit, as China's demographics forces its growth slightly lower, just places us in a slightly cautious position in terms of growth assets. Fixed income assets have performed well as interest rates started declining. And so we're in a very neutral setting right now, waiting for the next phase of growth to come through for the world.
Okay, so Bianca, in that vein then, are there particular inflection points for local or global markets that are blinking bright on your radar screen at the moment that investors should be watching? So let's extend some of your thinking now beyond just the currency scene.
I think what's really, really important when an investor starts looking at investing their funds is first and foremost asset allocation. And oftentimes when we talk about asset allocation, investors get the sense that, fine, I need to invest my money, but I need to put it in a broad array of asset classes. But they normally miss the point of diversification in jurisdiction as well. And I think that is a really key factor to take into consideration. Concentration risk in just rand allocated assets will over time erode value in real terms. So I think from a wealth management perspective, it's very important for your advisor to guide you in terms of where you should actually be positioning your assets from a global perspective. And then also for a wealth manager to really make sure they understand the full context of the investor and their needs, objectives, and cash flows in particular, and risk going forward, because that will really drive the sense of where you are investing, how you are investing, and what asset classes you are looking at.
Yeah. So, George, what does that spell for risks on the horizon that you're monitoring and potentially going to have to manage and mitigate against?
So after Bianca and the advisors have set the client's money in, then we have to really manage the risk on the ground. Right now, geopolitics dominates everything. It started with Russia, Ukraine. We've all kind of forgotten about that, but it's still going on. And then the Middle East tensions started developing between the tensions between Israel and Hamas, which is now metastasizing into something larger. The risk of Iran entering that, Iran's nuclear capabilities, that of North Korea as well. On top of that, we still have the China-Taiwan issue been bubbling for years and is coming towards a head. So there's quite a few geopolitical issues. And then just when you get calm about any of those, then Mr. Trump may enter the scene in November. And we are experiencing expanded trade wars against, between China and the rest of the world. Europe just this week voted in for more tariffs against China, against Chinese electric vehicles. And so these trade wars are growing. So although they're not physical wars, they are as important from an investment perspective. And that is very worrisome to us. Mr. Trump will be a wrecking ball in that process. And so I would say that trade wars over the next 6 months is probably the number one risk.
Yeah, absolutely. So all of that considered then, Bianca, and I know that you've touched on diversification there, but what approaches are you taking with your clients to mitigate risk in a dynamic financial landscape to ensure their financial well-being and growth?
So from my perspective, I actually look at two sides of the spectrum. First and foremost, we have the individual investor, and it's very important, like I mentioned, to actually understand their profile, what their objectives are, and then also working closely with our asset management team that George heads up to make sure that we are positioning them not only in an environment where they can see growth, but also in a way that they are defensively positioned for a potential sell-off. From the corporate side of things or the company side of things, those are typically clients importing and exporting, and they are exposed to rand fluctuations. And in that instance, we actually take a portfolio approach to efficiently hedge the client to make sure that we protect them against any adverse movements. And that portfolio approach is typically a combination of spots, forwards, and options to make sure that the client can benefit from a positive movement in the currency, but they are still protected at a worst case level.
Okay, got it. So, George, how do you then leverage Citadel's global presence to help clients get better returns on their investments?
Alishia, two important things. The first one is that the opportunity set of investment choices are just so much larger in the global context than it is only in South Africa. So purely by accessing a global investment framework, we have so many choices. We can invest in products, groups, and assets that have a totally different return signature than to what we are exposed to in South Africa, exposed to different factors and different sectors. And that creates a far more balanced portfolio approach overall for the client. So a bigger box of Lego to play with, many more blocks to play with, which is fantastic. And the second thing is Bianca's world, is that then a client is exposed to hard currency assets as opposed to only being exposed to the rand. Having all your assets in South Africa is fantastic. If you live in South Africa and you can stay in South Africa forever, that's perfectly fine. But if you have any international liabilities of any sort or any aspirations or legacy issues that want to be left behind, you need to create global wealth in hard currency. And so that international presence is crucially important. And then Bianca and her team handles the whole process of getting the money abroad and managing it abroad.
Well, let's leave it there. Thank you both for having joined me today. Bianca Botes is Director at Citadel Global, and George Herman, Director and Chief Investment Officer at Citadel as well.